Welcome again. This is Robert Schein, Managing Director, Partner at Blanke, Schein Wealth Management. Thank you for joining us for our Friday Insights edition, October 7th of 2022. And we're going to carry over from our conversation yesterday. That's why I have the board still the same, but we just modified it with today's data. Yesterday, if you watched my market insights and observations, we basically discussed, I specifically pointed out the three things that matter in the market and what we're watching. And it's the labor market. Today's labor report shows that we're still in a tight labor market. Now, labor market is easing some, but we're still at 3.5% unemployment rate, which is historically another, basically, we're in line with the lows. So that's good. It's healthy for the U.S. economy, Rob, right? Everyone has a job. Well, that's not what the Federal Reserve thinks, and that's not what the markets want. Why? Because the Federal Reserve is watching a tight labor market. That's wage inflation. That's inflationary pressures that are sticky, and that's going to make their job for the Federal Reserve harder, which means the job of the Federal Reserve has to be hawkish for longer. Again, if you watched yesterday, the day before, I was on Yahoo Finance TV, and I referred to all of this, and that's what the labor markets are what we're talking about. This morning, they added 263,000 jobs to the U.S. economy, which is actually a little bit cooling off of what was originally the first 6-month run rate of this year for 2022. We had 400,000 jobs a month added at the very beginning. So we're showing the trend is cooling. The markets just didn't like it. It wasn't cooling enough. Essentially, the Federal Reserve is waiting for this. Now, I said yesterday, labor markets, the Federal Reserve is watching that as well as the markets are watching that. I said, what direction would this thing break? Well, here's where we are. The dollar's up because interest rates are up because the Federal Reserve has to continue their hawkish policy that they support both of these. And then the S&P 500 and all the markets are down because of this. Okay, so this number needs to essentially go up and this number needs to come down, meaning we need less jobs created or added in the U.S. economy. I know it's counterintuitive, but that's what you get when you're in the middle of sort of market cycles. And so a client of ours, several clients today, we were in the office and we were talking about the most recent data that we had. That was produced. Yuri and Timmer from Fidelity had a great chart that we're now going to present to you in just a second on the screen. And essentially it's showing the historical cycle of a bear market. And last Friday Insights, if you're tuning in, we're talking about historical markets and specifically bear markets, how long they last, what's the duration, and so on and so forth. Now, the chart that we have today shows exactly where we are for 2022. In fact, the inflection point when we started, in this case, it shows in the overlay of every single bear market going back for 100 plus years. So it's charted here showing that we're not much different. And I'll have the chart pull up right now as I walk through this. So if you look at the black line on your screen, the historical approach to 2022 of where we are with the markets being represented there, in December of 21, we have the apex. Now you take all of the historical bear markets and you basically mirror them and overlay them, and you're seeing everything from the 2020 market to all the way going back to the early 1900s. So you're seeing the trajectory as this plays out if you just follow along. Now I've added a line, a horizontal line, that is just under our basically a 25% drawdown in terms of percentage terms where we are right now. Which is the 2022 level. Now, what we see, and I also added an arrow on the bottom axis that shows December of 22, meaning in just a few months at the end of the year, where historical bear markets have then played out. Have they dipped? Have they turned around? Where are we in terms of all of this pain that we're feeling and seeing, especially going through this process right now? Again, we own quality, we're balanced, we're diversified, we are maintaining the course, and we're taking advantage and putting cash to work. But at the same time, we know at the end of the day that there would be a light at the end of the tunnel. Do we know when markets turn around? No, we don't. Do we know the inflection point? We can't predict that. I wish we could. But what we do know is if we look at history as a guide, as we're showing you on the screen right now, the trajectory does turn, and we're closer to that, we would believe, simply because we believe that the Federal Reserve is closer to basically plateauing on their interest rate aggressiveness or their policy. They may have to continue in November, they have to continue in December, but at some point in time, they're going to have to get to cruising altitude because they've taken off way too quickly year to date in terms of raising interest rates, and that was the whole idea. But once they get to cruising altitude, markets then recalibrate and we basically price the price to earnings ratio, or the valuations, if you will, and then earnings kind of get leveling out. Corporations start basically having, okay, now we know where our cruising altitude is with our risk-free rate of return, which is essentially the 10-year treasury. And that should actually start moderating as well. Interest rates in the economy, even mortgage rates later on next year should be coming down, because they're close to 7%, if not 7% on a mortgage. That's unsustainable this quickly, because we started at 3 earlier in the year. So if we look at this chart and we see, and we keep going, as we go through this, there are all these other iterations. Now, that black line that I drew right across the bottom line, and also shows where December, later this year potentially is, and all the other sort of iterations that we've seen. We have certain years that are even worse than where we were at that point in time as we project through. So we look at the right-hand axis, 1929, right? The worst year that we've had in the stock market of all time. So that's all the way down the bottom, and markets haven't recovered all the way to the bottom. Are we in a 1929 market? Absolutely not even close. 1937, again, we're not even close to that type of economy. Therefore, projecting that kind of market outcome would not be even in the realm of expectations. So you see all the iterations below, and as you see, we're getting closer to an inflection point. We're getting closer to potentially markets moving in a direction, whether it's sideways, whether it's down a little further. We could expect and experience more downside from this point forward. But we're also showing that once we have a long-term perspective and time horizon, as we do as investors for our clients at Blanke Schein Wealth Management, you get years like 1994. If you look at the chart, once again, look at 1994. That's when there was another bond market where the Federal Reserve wanted to raise rates, and they turned and they pivoted. And then once they pivoted, the chart goes straight up. That's why we stay invested, because we don't know the direction, the timing, or the trajectory. But what we do know is that when we've been through what we've been through, and we own quality, and we do some portfolio strategic rebalancing between now and year end, take advantage of some tax opportunities for our clients, which we're doing, we're positioning ourselves for long-term outcomes that, historically speaking, have been positive moving forward. So there's only a handful of down years below where we are right now. If we go past December, again, I'm not predicting, not projecting. We don't know. But what we do know, historically speaking, is when the U.S. economy is in recession, the market actually goes up at the same time or even a little bit before. So even though there's a global recession on the horizon, there's a U.S. recession in 2023 projected, the market, the equity market, has already been discounting that this year in anticipation of next year. Keep in mind, the equity markets are a forward forecasting mechanism, and that's what we're seeing play out in the S&P right now, and the 10-year, as well as the dollar. So that's sort of a recap. I hope that chart helps you historically put sort of the where we are as well as where we could be moving forward. Again, we don't know, but at the same time, you want to look at history as a guide, because it makes it, puts everything into perspective as to where we are, but where we could be. So that's our Friday Insights edition. If you have any questions, please reach out and give us a call here at Blanke Schein Wealth Management. Thanks for watching as always. Take care.